everyone, and welcome to the Jeff Bullish Show. Today I have with me Charles Carillo. Now, Charles is a managing partner of Harborside Partners, a real estate syndication firm that has been actively investing in multifamily and commercial real estate since 2006. In fact, he started investing as a side hustle. I want to find out more about that after he finished college. But since that time, he's invested over $200 million worth of real estate. Charles is also the host of the Global Investors podcast. That's why he looks very, very professional there. And he interviews professionals about investing in US real estate. So welcome to the show, Charles. It's an absolute pleasure to have you here.
Thanks so much for having me on, Jeff.
So this is not anything to do with real estate. I'm going to ask you the question is, what brings Charles joy? What puts a smile on his face every day, or maybe every 2 days? But what brings you joy, Charles?
I love Italian cooking. I got my dual citizenship years back, and it's something that I love cooking Italian food for myself and family and friends.
Right. Is it so? The last guest said that as well. They said that, and I asked, now this is the other question I want to know is, when you're cooking, does everything else just fall away and that's all you doing? It's like time stops almost in a way.
Yeah, it's kind of a serious process. I will, headphones go in kind of, and it's kind of like, don't bother me for an hour and a half and then we'll eat. You know what I mean? Time's irrelevant. We could be, I know you want to eat in a half hour. It could be an hour and a half, but we're going to eat at some point. It's just, that's how it works.
That's awesome. Sort of cooking does my head in because I find that getting the ingredients actually almost takes more time than the actual cooking. But yeah, maybe I just need to practice more. But that's great to hear. So I like the fact that you put headphones on. So it's almost like you're practicing for a podcast by cooking. Okay, Charles, let's go back to, when you finished college, you said to me in our little preamble, said that you started investing in real estate pretty well straight after college as a side hustle. So what inspired that?
So just a little background. My dad has been a real estate investor since 1984. And him and a partner at one point, they had probably like 100, we call it like flat. We call it multifamily here in the United States, but it's like apartments or flats, what you would call in other parts of the world. And that they would rent out. They own the buildings with these separate units in it, and they'd rent them out. And so I got a second education growing up during the week and on the weekends with my father, dealing with all the interesting things that happen when you own real estate. And, you're kind of self-managing it, what we'd call. There wasn't really a third-party manager. He hired people himself to manage the properties, but he was also involved pretty daily into those properties. So when I got out of college, my dad pressed it upon myself, I guess, a little bit more to buy a property. And it was, if I didn't have him, I wouldn't have done it right away. And I did it right away. And how I got involved with it in the United States, we have a thing they call it now house hacking, but really it is, you're buying, at that time I bought a 3-unit building. I lived in one of them and I rented out the other 2 floors, and It was able to cover a lot of my mortgage. And as someone that just graduated college, not much money, it was a great way of going about it.
Right. And with your dad, I suppose, essentially sounds like you're almost following around and learning by doing. Because you didn't do a degree in real estate investing, did you?
No, I didn't. It was college had something. It was like a mix between, it was actually entrepreneurship, but it was really just management, a management kind of marketing type of degree. And they give you a little bit of all these different facets of business that you have to take classes on. So you have some accounting, you have some management, you have some marketing, which it's great because it gives you're pretty well rounded in those fields when you leave.
So when you chose that degree, was that driven by dad already investing in real estate, or you had basically thought, well, I'm going to be an entrepreneur after I graduate? That's sort of where you're going to move to? What?
Yeah, so I had been an entrepreneur prior to going to college, just like, doing stuff online, putting up websites like in end of middle school, high school, selling all types of stuff I get my hands on. It was like, before having a website, I remember like it was like selling on eBay, and eBay didn't even take credit cards. I had to give cash to my dad to write checks to. I didn't even have a checking account, so I gave my dad like $8 to write a check to eBay, and apparently, I mean, it got to eBay somehow, and they, across the country, and they, they cashed it. So that was a whole different kind of wild west, I think, of the internet and putting up websites and all this kind of stuff. And so when I was in college, I really changed that around. And as we were talking about beforehand, I founded a small payment processing company, and it's how the business really ran in a nutshell was really, I really focused on the sales part of it. Once I had these accounts or these businesses that were interested in payment processing, I would bring them to a processor that I had an agreement with, and then I would get paid in ongoing percentage, royalty, residual. It was passive income at that point. So the whole thing was really semi-passive, I guess you would say. So you had passive income many times, but then you'd have that 5 or 10% of clients every month that would need some sort of contact with you, but most of them weren't. So that's why I'd call it like a semi-passive.
Right. So did you have a full-time job when you left college, or what did you do?
Nope. I had this. I was running some small other online businesses during college, and I started this, I think, in sophomore, junior of college, and then I kind of went full into it when I got out of college. But the last year of college, I was working pretty full time, getting this to the point where I wanted to, and I really kind of got out of college. And it was like a year after college, it really, I really started to see it, because once you can really spend a lot of time on it, that's when obviously you're able to really make progress in what you're focusing on.
Yeah. So the focus wasn't real estate at the time. Real estate was more a passive investment, in that you manage the units, obviously, in your 3-unit building.
Yeah. And I worked at that. I worked at the property as well. So it was something that it was very easy. And it was very part-time at that point. You learn about dealing with tenants, which is great. You don't have to drive anywhere to this property, so you don't waste that much time. And if you're working at the property, it's even better, because if something had to be fixed, you have a handyman come over, you go downstairs, you open up the door, they fix it, you know what I mean? And everything is pretty simple. Obviously, some people don't want to live that close to tenants, but it's not something I don't think my wife would sign on now doing, but it was something, in your early 20s, what do you know? You know what I mean? What do you, it's like, I just left college. So
yeah.
So what was the next step? So how long was it after that initial investment that you started to double down a little bit more in investing in real estate? And how did you fund it? That's what I'm curious about.
Yeah. So I end of 2006 was when I bought my first property, which was right around the height. I think the height was somewhere in the United States, somewhere in 07, beginning of 07. And then my second property I bought, it was like a block and a half away, another 3-unit property. And that was like, I remember exactly, it's October 1st, 2008. So context, just why I would know that is because it's like 2 months after Lehman went down, approximately, and like 2 months before Madoff came out as a fraud. So it was like every time you turn on the TV, it was like somebody new was going out of business. It was just a completely insane, which if I knew any more about anything at that time, I probably wouldn't have done it, which was great. But it was a great investment. It was definitely one of the best properties I had bought at that time, for many years afterwards. And then I bought another property. It was a commercial property. So it was a mix of had like offices on the bottom, and then it had apartments above it. And I bought that like at the end of 2009, 2010. And that was just like everything was just in turmoil. So everything was a mess here in the United States when it comes to real estate, and a lot of other places throughout the world. But, I was buying at this point, because I'm originally from Connecticut. This was all in Connecticut. I moved to Florida in 2012. So Florida had a much bigger peak and a much, bigger valley afterwards. But Connecticut went up, peaked in many places where the area I was in, but it really never came back to those same levels, even during the last kind of 2022, 2021 type, price escalations we had here.
Right. So is timing important as a real estate investor?
It really depends on what your strategy is, and you can make money in all types of markets in real estate. What I had a very slow and kind of dumb way of approaching it, in the sense of that these were long-term investments, and they were bought with long-term fixed debt, what we call here. So it's like there's no interest rate changes throughout that. We usually have a 30-year term. So, throughout that 30-year term, the term of that mortgage, you don't have to worry about any changes to your principal interest. Just your taxes or insurance can change, and those are your major expenses. So buying real estate like that, and then knowing that it cash flows, you have positive cash flow every month, it allows you to weather a lot of the storms. And so when going through, 09, 2010, any of these times, if you just kept people in the property, you kept it rented to good tenants, it didn't have any issues. Now you're not getting major rent increases. You were getting, 2%, 3%, but you were still, that was what inflation was back then. So it was just, it wasn't it's not that, it wasn't that sophisticated of a investment strategy. The investment strategies, when you're looking for a shorter period of time, that's when it becomes, you add more risk onto that because you're getting shorter term debt. So if anything goes wrong in that 6 months or 12 months that you have that debt, you're trying to flip a property, that's where you can get into hot water. Because if anything happens, if you have a 30-year mortgage with a major bank, and you got 29 years left on it and everything dies and you're still paying your mortgage, you're not going to have an issue. The problem happens is that when you have that short-term debt, they want their money back, right? Everybody wants their money back. They're not going to give you any leverage at that point. They're not going to say, oh, I'll give you another month or anything like this, or they're not going to work with you if you find a problem with the property. If you find a problem and you can't sell it, you can't rehab it, whatever the issue you're having. And so that becomes a much riskier situation. The other thing too is when we're having like a pullback in the market, if people are buying properties for this short term, they really have to buy the property correct. When you're buying for longer term, especially in like growing markets like we do down here in Florida, it's something that you have a little bit of a buffer because you're buying it for long term. You're able to, pretty much kick the can down the road, for lack of a better word, to a better time if you're having an issue at the property, or the economy is not where you want it to be, the price of the property is not where you want to be, the value is. You can work on it and you're not forced to sell it. When you start taking the short-term debt and you're doing short-term investments, that adds dramatically more risk to the investment.
Yeah, that's very interesting because that's what I have learned about American borrowing for mortgages or for houses or real estate, is that when you take a loan out, it's basically you've got it fixed for like 30 years. Whereas in Australia, you can take out a fixed loan and the longest time a bank will give you will be 2 or 3 years of that fixed rate. And then whatever the interest rate is in 3 or 4 years, start 3 or 4 years fixed, so then it goes to variable. You end up paying the current interest rates, which have gone through the roof in the last year. So in Australia, for example, we would be borrowing, might have started at 2%. Now it's up to 5.5%, 6%. So you can imagine what that does to your planning as an investor, whereas you've got it fixed for 30 years. That gives you security knowing that you can just play the long game. So what you mentioned about short-term debt, that's when it becomes dangerous, doesn't it?
Yeah, the short-term debt's when it becomes dangerous, and the same situation that you're experiencing is similar to what they're experiencing around in the UK as well, where they're having that issue. And a lot of people, it's terrible that their interest rates are going up high on, when you can get variable rate loans, but people got really burnt with this during 07, 08. And so it's not as popular. You can still get them, but it's usually like something that, if you see the product, it's like 5 years, then it will change. Like you said, you're like a 3, then it changes every year or something like that for the life of the mortgage. But the main important thing here, or the main popular thing here, which makes sense, is the 30-year fixed. And then people, prior to this low interest rates, people in America used to only keep their mortgages on average 7 years. So now that's going longer because people have these fantastic fixed rates. You know what I mean? That are like, 3% or something. It's like, I was reading something, it's like 90% of Americans have a fixed rate or something under 4% or under, it's just, so that's why people aren't selling houses. But in normal times, it would be 7 years in that 7 years, they would sell their house and go to a bigger house or downsize or get a new mortgage. So at that point here, it's a little different because of this, how low we went and how high we went. A lot of people refinanced and, they don't want to lose those rates.
Yeah, so it's very interesting. So there's quite a difference in terms of that market in America, the USA versus the UK and Australia especially. So let's then talk about how would a investor foreign investor invest in real estate in the USA? How does that work as a foreign investor?
So there's a couple different strategies that investors can use. Number one is you can invest into, which probably one of the easiest ways of doing it with the least amount of investment is going to be going into a REIT, a real estate investment trust, and they can purchase that probably right through their brokerage account and something like that. That's one way of getting exposure to the U.S. market and to all different types of classes of real estate. So if you want, retail in there, you want restaurants, anything like this, multifamily apartments, what we deal with, anything like that, you can get exposure to. What we have talked to a lot of people about, and what the podcast is a lot about, is people come to the United States or interested in investing in the United States as a passive investor, and or they can become an active investor, which is taking a whole nother, just like you would be investing into real estate in Australia, which all the people that you need on your team, you have to now rebuild that on the other side of the world and into a different country with different laws and regulations. So that makes it a lot more difficult. When we're working with international investors, we typically, they'll come in and work with us as a passive investor. So what happens really is they set up an entity in the United States, usually an LLC, what we normally use for real estate, and they're able to invest into an array of different deals from different syndicators, operators, what we call deal operators like ourselves, and that allows them to get exposure to different properties. And their investment's going to be a lot smaller, typically, compared to what they'd be investing into, say, if they bought their own, say, 5-unit or 40-unit apartment building. So that's one of the pluses. The other thing, too, is that you don't have to do anything. It's completely passive after you make that investment. And how it works is we typically will send out like monthly reports to investors, and then they'll usually get a quarterly distribution from the profits of the property. And those are really the three main ways that people can really take advantage of investing in the United States.
Okay, so yeah, I suppose setting up a company as a foreign investor just depends on what level you want to play. But so what are some of the opportunities you're seeing at the moment? Because the pandemic pushed up prices, didn't it, around the world, really?
Yeah.
And also there was, and always with real estate, there's markets within markets. So one suburb can differ to another. So what are some of the big trends you see in real estate that you think you should be aware of? Is it catering more for the elite, ultra wealthy, the middle market? Where do you think the opportunities lie moving forward? Because the prices went up during the pandemic. People could work from home, so they wanted to buy a home, work from home. In other words, house prices went up here and apartments didn't in Australia, for example. So what are some of the opportunities that you see post-pandemic that you think are worth noting in the USA?
So how our strategy works is we really focus on what we call B-class apartments. And then B-class apartments are apartments that have been built from, say, 1985 to 2005, 2010. And these are properties that probably haven't been updated that much. However, they're in good areas. We call them B-class areas. And they have a solid tenant base there with actual real jobs, solid jobs. When we're doing underwriting on these tenants, we typically are looking for 3x. So that means that they're making 3 times more, or the household is making 3 times more than what the rent is, which allows them to afford that mortgage. We stay away from very high-end apartments. It's not something that we invest into. The reason for that is, number one, is that right now we have about 4.3 million apartments that we are missing in the market that are needed to cover the demand. And these are mainly in what we call the Sun Belt. So in the Southeast where we invest, these are these places that are high in growth, that people are losing the growth from the Northeast. They're coming down to the Southeast where we are, Florida, Atlanta, Dallas, these places, and Phoenix as well. And these are the areas where people are moving to, and this is where these apartments are supposed to be or need to be built. So when you're buying these newer apartments, you're competing with anything new that's built is going to be competing right alongside that. So if I'm buying an apartment built in 2017, and there's something new that's going to be built right now in 2023, and the rents are similar, obviously they're going to go with the newer place, and it's going to be difficult. And that's going to be, let's say, $2,500 a month for rent. And if I'm, a half mile down the street and we are in, so pretty much the same area, and we have this B-class property that's, say, 30 years old, but we've just renovated the units. We've updated the whole pool and the amenities in the gym. And, our rents are going to be at, $1,700 a month. And that's where you're going to be able to pull people that are going between, say, lower apartments that want to get to a better price, better product that can't get to the higher one. They're going to be right there where we are in that B class. And that's really what we've seen over the years as one of the best places to be in real estate. I just see that we have a lot of inventory that was started about 3 years ago, a lot of apartment buildings that were starting construction that are going to be coming online here shortly. And then a lot of stuff pulled back last year. So that's going to slow down what's coming on in 2025. But if you're in that slightly older window, but not too old, where you're getting into less than ideal properties and less than ideal areas, but not the brand new product, that's something that can't be built, because if I tried to build the apartments that we have now, we can never rent them for the $1,700. You know what I mean? It just wouldn't make sense. And it makes no sense too. If you're going to build a property, you might as well spend an extra $1,000 or so, a couple $1,000s per unit to make it, put in all the nice finishes and all the nice appliances to get it to the next level. And it doesn't make sense to do that. And our type properties, we can get as close to that, but there's always going to be little differences from what was built 30 years ago, which is today.
Yeah. So what you're really saying is buy something that can value add to.
Yes.
Yeah.
Yeah, that's correct. That's exactly what our strategy is.
Yeah. Because then you can actually, so if you're just buying a brand new apartment, it's modern, everything's done, it's squeaky, new design, everything, no value to add there. Now, so the other question I have about apartments is, now I don't know what you call them in America, but strata fees. In other words, you are contributing towards the maintenance of the block. How's that done in the USA? Over here in Australia, we have strata, which you contribute to both maintenance and day-to-day care as well. So long-term maintenance, like you might have to upgrade the fire safety, for example, or the building has some concrete cancer in it, which needs to be done for the whole block. How does it work in the USA with paying for the unit block and is that called a strata? What is it called in the US?
Yeah, so that's a very interesting. This is one difference between many different countries in the United States. First of all, when we're saying we're buying apartments, we're buying the whole building. So we will buy a whole building. What we focus on is 100+ units. So we'll buy what we call a whole complex, and so we own all those units within them. We usually will have, when I say amenities, we're in the Southeast, so we'll have a pool. We'll have a gym. We'll do work to these to get them up to the level that we want them at when we buy them. And then we'll have a small office and we'll have full-time staff. Say it's 100 units. You probably have 2 or 3 full-time people, a leasing person, a handyman, maybe a part-time handyman as well. And this is all really self-contained. What you're explaining to is what we call here in the United States like an HOA, homeowners association. And that's really with condos. And that's a very similar premise where we might have a building that could be 5 units, it could be 500 units, and everybody will pitch in to the maintenance of the property. And then if there's not enough money, the homeowners association doesn't have enough money, they have to do what's called like an assessment, especially like if you have a major problem like you're talking about with concrete that probably people heard about when in Miami about 100 kilometers south of here where we had that high rise that fell down. Yeah. So that was something that it wasn't maintained and stuff like that. So when you're buying a condo like that, you have this HOA, and in certain areas, especially down in Miami, they're very expensive, thousands of dollars a month for this HOA, depending on the amenities of that property. Because there's some buildings that have, it's very simple. Like my parents live in one on the beach. It's very simple. 30 or 40 units, not a problem. You go to some of them in Miami and they've got, valet parking and a concierge. So, I mean, you go to your level of the property that you really want, but you have to pay in for that HOA, which is similar to what you're explaining. But how our strategy is really just buying the complete building. If we ever wanted to, I guess we could change those into condos and sell them at a premium. But the goal here is to control the whole property. We can do our upgrades to the unit as we own it over our proposed 5 to 7 years, and then we don't have to worry about any other owners not going along with us, or just like getting in the way, because then when we sell it, it's going to have a much higher value to the end buyer that now has an upgraded asset that makes more money that they don't have to do anything with.
Yeah. So it's actually quite a different market in Australia, really, compared to the USA, because some of the strata fees, for example, and they don't have to be, well, they're nice properties, but it can be $15,000-$20,000 a year per apartment, and that quickly takes away your rent yield.
Yeah. And you can't control that. That's the problem too, is that, and what we have a problem here in the United States, and when I talk to people, is that, so all these different HOAs, like as you were saying, stratas, I mean, all these different, everybody has different goals of what they're trying to do. So the problem is that if you get into one of these associations and these HOAs are lower, they might have a lot of deferred maintenance that hasn't been done, especially if people are buying them for investments. And that is where it becomes an issue, because say you have 100 units and say 65% of them are investors that are buying them. Their only goal for that is keeping that monthly or annual fee to the association as low as possible, which means that they're probably not putting away enough money for repairs, for the future concrete work, for anything that needs to be done in the future. And then at some point in the future, then they say, okay, everybody's paying $15,000 or what, you know what I mean? Or we have this huge problem and the property is not maintained as much. So when you're buying into these properties, if you're buying them as, you really have to do as much due diligence on your individual unit as you do on the whole association,
right.
The complex that you're buying them, because it's really two due diligences, that because you're going to be living or owning both of them.
Yeah. I remember someone bought a Harborside apartment, didn't do their due diligence, or their lawyer didn't. It was about a $900,000 apartment, but they got hit with $180,000, because there was so much. Lived near the sea, concrete, iron are all part of a building. So someone didn't do their due diligence. So what you're talking about, and that's quite scary. Like, where do you find $180,000? Take a bigger mortgage if you don't have the cash flow. Well, then it's a problem. So, but what you're talking about is getting as much control as possible, aren't you?
Yeah, there's people that have done a strategy similar to where they might have a building with 100 units in it, and they want to buy 55 of them or 60. And I always avoid those. We turn those always down. We need to have when we buy, we have to buy a complex that we own everything. And that way that you can, because then we're going to rebrand it. So, because it's probably going to have, it's going to have some sort of like Google rating in like the 3s or something, and we want to rebrand it with a new name. We want to put new signs. We want to repaint it. We're really putting this. We're remarketing the whole property too, under everything, and that's where we're going to get the value, and that's where we're going to be able to turn it around. And you're going in there. You're taking out troubled tenants. You're putting good tenants in there. You're actually doing your underwriting. reviewing the background of these tenants that are coming in, making sure they're fine, and getting rid of old tenants, getting rid of old managers that maybe kind of were just, not doing what they're supposed to. And you're really coming in and changing the whole thing up.
Yeah. So it's basically total control. We can add the most value, if we wanted to sum up what you've been saying for the last 5-10 minutes. Is that correct?
Right. Correct.
I love it. So someone wants to start investing just like you. Would you recommend trying to find a small block of units, like 3 or 4 or 2? Is that where you'd think you'd start?
I would think whatever your goal. I mean, what is if you're investing here in the United States, and let's just say you're coming from a foreign country to do it, it would be something that I would really focus on. I would focus on exactly what your goal is. And if your goal is, I want to start an real estate investment business in the United States, then I'm probably going to start with properties, actively purchase them. And I'm going to put together like a team over there and find out exactly what size properties I really want to start with, because we do have a lot of international investors that come into the United States, especially in Florida. And that's kind of what I would do. And you could start with smaller properties. The thing though, is that when the smaller the properties, the cash flow, the monthly cash flow is more volatile, because you don't have as many streams of income coming from that property. Yeah. So if you bought a 2-unit or something like this, and half of it's vacant, I mean, that's going to kill your cash flow. If you have, say, putting a new $8,000 air conditioning unit in there or something like this, That's going to kill your cash flow. Compared to if you went in maybe with a partner or two and you bought something that was 15 or 20 units, that's where 2 units are vacant or not paying. And then you have, 16 that are paying on time. And then you have 2 that pay late. I mean, you're going to be able to cash flow and, you're going to be able to put money in your pocket every month and build up a nice reserve fund from that. So it's a little bit, when you're buying smaller properties, the cash flow is just not as consistent.
Right. So you mentioned what are the goals of the investor. So you're talking about basically 2 types of goals. In other words, you want to generate cash flow would be one goal. Is that correct?
Yeah.
And what are the other goals that are important to investors that you've seen over the years?
So you talk to some investors that actually want to be active investors. So they want to come over here. They want to pick the properties. They want to have a team. They want to hire the manager. They want to be having more. They want to have more control over the deal. And that's whatever people like to do, but that's going to take more work. We have other investors that come that invest alongside us, and it's much more of a passive role where they're really investing usually $50,000 or more into a deal. And at that point, they're able to invest alongside us, and they're able to get exposure not to a smaller property, but into something that might be 100 units. Or our last property we bought was over 500 units, but typically they're about 150 units that we usually buy, size of property. And now you're able to we have a lot of scale of economies in there that you're not going to have that ability to. And that's going to make it a little bit harder for you to make money on. But a lot of people start, if you want to be active, I started with small properties. There's nothing wrong with that.
Yeah. So let's get on to the biggest mistakes that investors make in real estate. I'm sure you've seen quite a few mistakes over the years, and you've learned from them, both by actively doing and starting small and then getting bigger. What are some of the biggest mistakes real estate investors make?
Yeah, I would say some of the bigger ones are, number one, they're buying in areas that aren't the best. And I don't have to say you have to buy. We just said we're not going to buy in A+ areas, but you want to buy in areas that are, they're solid property, they're solid areas that are growing, that are, that are going to be able to appreciate. When you go into lower areas that you maybe don't want to live in yourself, that's something where we call like less ideal or C or D class properties. These properties don't appreciate as much. They become more of a management burden on the investor and on the manager, which is a problem, because if you're not self-managing them, then, either way, it's more time consuming. There's going to be more headaches. It's going to be constant calls from the property or from your manager. So you can avoid that by buying better properties. The other thing I would say is people not having a reserve fund. So whenever you're buying properties, you need to have a separate reserve fund. And just like you would with running any type of business, but in this scenario, you need to have a reserve fund that you add to every month. And that's completely separate from the property. And that's where you're going to put money into that you make from the property. If you know that 10 years down the road or 5 years down the road, that roof's going to have to be replaced, then you're going to put additional money in there to make sure for that. But also, there's going to be emergencies that pop up, and having access to that capital so you can correct the problem correctly as fast as possible. You don't want to do something halfway that you have to go back, especially if you have tenants there. You want to keep them happy. They're paying rent. You want to make sure that they stay. So that means that you're correcting any issues as soon as possible. And then the last thing I would say is they're not investing for cash flow. When you're doing out your numbers, if the property doesn't cash flow, it's something that I would avoid. It's not something you want to do for your first couple properties. Once you get down the road and you find deals that are a little bit more of what we call heavy lift, like a major renovation, something like this, you can do that down the road, but don't do any kind of major renovations on your first couple properties. Figure out exactly what you're doing. I made the mistake on my first one of not doing like a major renovation, but it was more than I wanted to handle. My second one was a very light renovation, and my third one was a major renovation. But at that point, I had like a team, I had good contractors, stuff that you don't have on your first property.
So the first point you mentioned was about investing in the right area. In other words, a quality area, not elite, as you mentioned before, but a good, solid area. How do you go about doing research for that? I know you guys would be doing that all the time. You must have got a team of researchers that does that. But if you're doing it on your own, what sort of research should you be doing?
Yeah, we have a number of great websites. If anybody's ever really interested in this, just my contact information will be at the end of it, and you guys can reach out to me and I'll send it to you. But we've different websites, and we have a lot of data that we can pull up, and we can put addresses in, and it's all free, the stuff that we normally use. And it will tell you the incomes per neighborhoods, and you can really see where those lines are made. Because when you're doing, the good old days without the Google Maps, you would drive around and you're like, oh, whoa, this is a lot different than this over here. And you might look down when you're on satellite view, everything looks great, right? And you don't see that there's a train track there and there's a road that really divides neighborhoods. So if you can do like an overlay on that, and there's other, I don't know the name of the website we use, but there's one great one where it really tells you exactly, draws the lines of where the income lines are. And that puts you right where, in the United States, like we're looking for the apartments we're buying, we're typically looking for people, their household income in these properties, 60, 80, we have, 80, 90, up to 100,000 is typically where you're going to find our typical renter base, right? And so, household. So probably if there's one or two people in there, that's what they're really making. So you can really figure out exactly where that is. And then if you go over here and you're looking at a property and it might be in that 20 or 30, it might not be exactly what you're looking for. So it allows you to really hone in, because you can't change the neighborhood. You can, if you're buying it really long-term and it's right on that line, maybe you'll get lucky and it'll change. But if how you're doing with us, and we buy, and I wouldn't say it's short-term, but we're buying for 5 to 7 years. That's what we'll tell investors, even if it's shorter than that. That is, in that scenario, that is where you really want to check and make sure you're buying in an area that is already seen, that's already solid, and you're just kind of riding it a little bit as it gets better.
Yeah. So you want to make sure that it's a rising demographic, hopefully, but you got to make sure you're buying at least it's good quality right from the word go, really, with the right level of income of the general population that are in that, I suppose,
Right.
suburb. So real estate's very much about knowing your numbers, isn't it?
Yeah, it's very much about that.
Yeah. So what are you looking at in terms of rent return? And I suppose that if I do a small renovation, in other words, paint, carpet, in other words, not major, you're not going to be replacing kitchens, or you might even replace a kitchen, but it's basically one from costs you 10,000 instead of 100,000. What sort of rent return is your guide at the moment that you're trying to achieve? And of course, the other one is adding more value. You're adding more value by doing a very simple renovation without spending too much. Also, you can increase the rent by doing that. But what's the rent return that you are looking for generally? Or is that too broad?
No. There's two things part of that. So those are great questions. So it's the one part is what we're looking at for a return. And every investor is going to, or should, kind of do their own self-evaluation before they invest and see what they really want to make. When we're going into investing into a property, and everything is there's no guarantees with any of this, but when we're doing out our numbers, we want to see if the property is going to make a 15% return. That's like the minimum. And I know that's high, but that's just something that for the risk that we're putting into the property, and we want to make sure, because we're going to share on that as the general partners, the operators of the deal. We're going to share on that with our limited partners, our passive investors. So we want to make sure it's 15%, usually in the higher double digits is what we're going to shoot at. And if the property can't do that, because you have to also think that's what we're shooting for. If there's any type of pullback that obviously we can't see into the future, we have to make sure the property is still making money. So that's why we shoot for that number or above. And if you see that, then there's enough meat on the bone where if there's an issue, a pullback, we're able to still secure, be able to pay all the bills, keep everything going. There's not going to be any type of issue. So that's how we're doing our numbers. And that's kind of the metric we use. If a property comes in underneath that, we might renegotiate with the seller, or we might just pass up on it, or do both. So the second part of that is when you're investing money into a property, and this is a great metric that I'm not really asked much, but it's our goal is that for when we're investing to a property to do renovations, we want to see whatever we're investing into the property, we want to get it back in what we call 36 or 48 months. Okay, so if I'm putting $4,800 into an apartment, we want to see that we're getting that back in 3 to 4 years. Okay, and if it goes over that, it's that renovation doesn't make sense. Whether it's the rents won't hold it because the area. So that means that you have to do a less a renovation that's not as in depth, right? Not as expensive. You might do something that's saying, hey, maybe we can get $80 more a month if we put in, $3,000 or something like this. And that's the renovation we're going to do. Where we are now, where we've been like over the last several months is that, we would go into these properties when vacancies come up and we say, okay, we're going to fully renovate this apartment. We're going to put $5,000 into this. And we're going to, and these apartments are usually like, somewhere around like 1,000 square feet. So that's like 100 square meters, right? Something like that, 90, 100 square meters. And so that's what we say. We have our contractor team that comes in there, say they put $5,000 into the unit. We want to see that we're going to be making back, that divided by 36 or 48, that 150, that $200 a month, we're going to be able to get that premium. If we have a lot of units that come up at once, we might do just 2 or 3, we might just do, say there's 5 of them, we might do 2 or 3 fully. And then 2 of them or 3 of them, we might just do where we just put $1,000 into it, where we paint it, where we clean it, and where, we change, some hardware on the, on the cabinet, stuff like this, and we re-rent it. Right. And then we might just say, all right, we're going to just test the market. We're going to put that rent at, $50 more a month and see exactly what happens. You know what I mean? That way that we don't have to outlay all this money for all the units, and we can kind of see exactly what rents faster. We might get a better return on just doing the cleaning and the painting. Obviously, you're not going to make as much money, so you're not going to raise the net income as high when you're doing that. But when you're going through an area at a time like now where we don't really know exactly, people tell us there's going to be a recession, people tell us there's not a recession, we don't know where interest rates are going. This is kind of how we act. Very, it's very cautious. If we're in a hot market, like if this is 2018, 2019, those 5 units come up, we're going to do 5 of them right away because we know we can get that premium. But when you're starting into an area like now, this is where we're going to kind of scale back that business plan a little bit. And some of the units we're going to do fully and some of the other ones we won't. And then next year, or when that tenant moves again, that's when we'll fully do that.
Right. So when you talk about 15%, well, let's say 15% return, that's very high compared to Australian values and rents. Okay, so let's say you bought, so when you talk about 15%, you're talking about gross. And in other words, if I bought 3 units, $100,000 each, total, block of 3 units, $300,000, I'd want $45,000 gross rent return. Is that what you're talking about? Is that the sort of, yeah.
Yeah, so it's that's great. So there's a couple different metrics that are allowing us to. There's a couple of things that we integrate into this deal that are going to allow us. We're not buying these properties with straight cash. Typically, what we're going to do is we're going to buy these properties. We're going to leverage them on the high end, 75% loan to value. On the low end, 65% loan to value. The other 25%, we're going to raise that from past investors. We're going to put in probably 25% of the money that's required. The general partners put 25% in, the other 75% required to fully fund the purchase and then also the renovations. We're going to raise that from past investors. So that off the bat, that's going to give us a little bit of a buffer, because if we're paying, say, 5.5% or 6% for that mortgage on that property, that's going to allow us the ability to now we're able to the equity portion of it, that 35 or 25% is going to be able to take the rest of that 15% gain where we're only paying 5.5 or 6.5% for our money. So it allows us to escalate our returns versus just paying cash for it. The other part of this is how in the United States, or how these deals work is when we do the distribution out to investors, that's only about 40% of your full return is coming out in the distribution. When we sell the property, that is when the investor is going to get the majority of their return back. They're going to get the rest of their initial principal back, and then they're also going to get the majority of the return at the end of the sale date.
Yes.
So when we're saying it over years, so for instance, if someone put in $100,000 into a deal, our goal is really, by the time that deal sells, we really would want to do what we call an equity multiple of like 1.5, 1.6, 1.7, something like that. So at the end of the day, when you add up all the distributions we sent you, when you add up everything that you got all your money back, everything you got from us, that's when we're looking at getting in that, $150,000 to $175,000. And the majority of that is going to be at the end of it. During it, you might just get, you might at 100,000, you might get somewhere between 3, 4 to 7%. You know what I mean? In the beginning, it's going to be less. Maybe year 2, year 3, that's when you're going to be getting 7%, and that'll be sent out to you quarterly. And that's, in most deals, right? Different deals have different business plans, but that's kind of how it works.
So really what you're talking about, when you run the ruler over it, you're going 15% return. That's over the lifetime. Is that what you're saying? Both capital as well as cash flow?
Yeah, that includes both. That's correct.
Right. Okay. That's what I'm trying to work out. Is it just you're trying to make sure you're getting 15% rent return on cash flow, which is basically almost unachievable if you did.
No,
so you're talking about you're building into that the capital gain that you're trying to predict both from your experience and also the market. So okay, I get it now. So the 15, I was thinking, wow, 15% rent return, that's awesome, but that's not what you're talking about.
Yeah, I'm sorry if it's different. It's not as clear. The main thing is that when that return comes back, that's going to include the majority of your return with it. In the United States, with these commercial properties, they are, not to get too intense, they're really priced off of what the net operating income of the property is. It's not like you're buying a property and go, oh, my neighbor just sold his for $500,000, so mine's worth $500,000 because it's the same exact thing. That's not how we do it. It's done off the net operating income, where you could have a complex here, a complex across the street, the same exact thing could make 20% more money because they just manage it better. They know how to handle the tenants. They keep the tenants in there. They have better amenity, all this type of stuff that you might not see from just looking online. And that's where they're getting that extra value. That's why it's very difficult you have to really get into the numbers with the commercial properties. And that's how we're able to do it, because we get in there and we're getting the rents up to market. We're doing work to get them to the top of what that property can handle over the whole lifetime. We're not going in there right away and, increasing people's rents 25%. But we know that, okay, from year 1 to year 5, it's going to go this way while we're putting work into the apartment. And there's a lot of people in there that we don't raise the rents on, you know what I mean, as you're not doing it. Because if you have 100 units and you have 20 leases come up one month, I want to re-sign 15 of those people, and maybe you give them a rent increase of 3-4%, you know what I mean? Just to keep them in there, right? Like close to market, even though you maybe can go 10% with what the market is, just how the units are. We want to keep them in there, and we want to stagger out those leases. We're not going to do 20 units in 1 month, right? Yep. So we'll do 5 of them. We'll keep those other 15 people, whoever leaves, you know what I mean? Because you're going to be people that want to leave, and there's going to be people that want to move into the new units too. So you can kind of try to keep everybody happy, and that's how it goes. And it's a lot of work because you have no idea. And we do this due diligence before, but you still don't know. Someone can leave before the lease is over. That's a lot of stuff. It's a lot of it's on the fly in the beginning.
Yeah. It's a lot of moving parts, isn't it? So, and that's the thing that I suppose investing through you, you're doing almost is it a syndication? What would you say investing with you would be, a syndication?
Yeah, it's a syndication. We have to go through the SEC and everything like that here in the United States because the investors are passive. And there's all different types of stuff of how people have to vet these deals, because obviously it's a long-term partnership. It's not like a stock where you can buy and sell at whatever your leisure is. These are partnerships, and usually over the last few years, they've been less than 5 years, but we always tell investors 5 to 7 years, because we can invest May 1st or something like this. And by September 1st, the market could fall out, and hey, we're in here for we got 5-6 years to go. You know what I mean? Yeah.
So with real estate, you're playing the long game. That's really what it's about, isn't it?
Yeah, that's what I found to be the best. The longer you own properties, I found to be the less risk with them. And
okay. So that raises the other question, is how do you mitigate risk? So there's the opportunity, and that's great. Everyone gets rose-colored glasses and going, I'm going to make my 15%, and hopefully you do. And you guys mitigate the risk by all your experience and also through regulation as well. So what is some of the ways that an investor in real estate can mitigate risks? Tell us those.
So if they're, as I mentioned before, mitigating the risk is if they're active, having that reserve, all that kind of stuff going with it, and investing for long-term. If they're passively investing in a deal, you're really investing into the sponsor and the operator. So getting to know that sponsor and that operator, understanding exactly what their business plan is and what their track record is number one. And number two is really vetting out the deal. And, the wealthier the people I know that invest with us, they really vet out the sponsor, and they're really investing in the sponsor. And that means that if that's what they're really putting all of their eggs in that basket when they're investing with that sponsor. The deal, yes, they care about the deal, but it's really the person running it, because the deal could look great, but something could happen and they need someone that can fix that problem that happens and rectify it and make sure that we're coming out fine on the other side. I passively invest in a lot of deals as well. And that's what I'm looking at. I'm looking at the sponsor. I'm looking at their track record. I'm also looking at, I want to know, I'm very interested about the team that they have on the ground. Okay. So if I'm investing in something, I want to know that, hey, we have 5 other properties like this within 25-minute drive of it. And so that means that, okay, so you have this system already worked out, and this is just a 6th property there, right? I'm riding. So me investing with you is that I'm kind of riding right in on your coattails, right alongside you. You've spent years, maybe decades, building up these contacts, and now I know that there's not going to be any issue with you having to change management, or you're not going to have issues really with vendors or contractors, because you've been in this so long and you have these teams that work for you on a consistent basis, and you don't have to change the management. All these things are all green lights. You know what I mean? The thing is like, oh, it's our first complex ever, or, you're not investing there. And it's like, my first complex in this one area, or the people boots on the ground, this is their first time there. This is all stuff, red flags you want to avoid. You want people to have a proven system in general, and then also a proven system in that area. And then you're like, okay, this is just really kind of printing money, because you have it all set. You know what you're doing. You know more about the numbers than anybody else would really know, because this is, you have 1,000 units there already, and now this is just an extra 250.
Yeah. So basically mitigating risk by riding their coattails and doing your due diligence on them before you hand over the money. And obviously that's taken you decades of work almost to actually, for you guys to build a reputation as you've. So is there any areas you're investing in that have been like amazing returns? Like, is there any areas that you're going, you obviously did due diligence, so the right area, right demographic, right age of units, like we've covered on all those. What's some areas that you've just known, wow, this has just been a fantastic investment? What areas in, I suppose, Florida is where you're investing, or?
Yeah, so we invest, where we have properties now is a couple markets in Florida, greater Atlanta, and then also Dallas. We've seen a lot of growth in all those markets. Over the last 13 months, we've sold 2 properties in Tampa, and we've exceeded what we said, but we also went through some fantastic growth periods there. So it's not, that's a market, and that's what we did. It's not just us. So, but that's one of the areas that's had great growth, Tampa. We don't, even though I live in the southeast of Florida, I don't invest down here. I don't, living in Palm Beach, I don't invest anywhere in the south. I really focus, if we're in Florida, it's really Orlando, Tampa, and we also like Jack. And then we really like Greater Atlanta. It's great. I mean, it's very business friendly. It's very easy to get to. It's a Delta hub. So it's number one. And then Dallas, 50 of our Fortune 500 companies in the United States are in Dallas. I mean, it's a powerhouse with people. And there's these places have, like, for the most part, especially like Dallas, a lot of articles on it as well, where they just have a lacking of housing. And when you're building houses and when you're building apartments, as we spoke about before, you're not building less than nice ones, right? You're building, you're putting nice granite in there. You're putting everything beautifully, appliances. So that's the thing, is when you're buying properties that are a little older than that, but still in these good areas, like we bought one at the end of 2022, and it's literally like a less than a 15-minute drive from downtown Dallas. Starbucks around the corner. That means that, we have Starbucks that has done their due diligence on the area as well. They know it's a strong area. These are all the things that we look for. There's a brand new A-class property less than a quarter mile away. So it's another group that's invested as much money that we've invested in the area. I'm putting brand new construction, and it's a great way, because they walk in there, then they walk into ours. Ours is a few $100s less per month. And if someone at that property, somebody loses some hours or someone loses a job, they're moving into ours. In a great market where people are coming out of those C-class properties, those properties that were built in the 60s and 70s, maybe not the best area of town, they're going to move into our asset. They're not going to be moving into that A-class asset. You know what I mean? And we're going to have access to better schools. And so that's really what we've seen is in these main three areas in the United States.
Yeah. So in other words, they're growth areas and they're in a sun belt almost. Is that what you said? Yeah.
Yeah. And the one thing about this is not just where the growth is. There's three things that we really look at. Number one, we're looking for population growth, which is easy. We're looking for where job growth is, and it has to be diversified job growth. So you can pull up all these numbers online and you can see exactly what kind of jobs are going there, right? You don't want to go into an area and 25% of it's military because that can be shut off when the next administration comes in. Yeah. And you don't want everything just like, oh, everything is in one type of industry. You want it really diversified. And the last thing we want to look at is we want to see a decreasing over 20 years in crime. And when you see a decrease over 20 years in crime, anybody can you can show 3 years and go, oh yeah, we locked up everybody in this town. And, and then, but we don't show them when they got out, right? Over 20 years, that shows you that they've not only had a strong police presence, which you probably see in the news a lot. There's cities that don't have that in the United States, but also they're reinvesting into education and health. And that means that people that have issues are getting the help they need. They're not just being let out, you know what I mean? And they're not being just locked up. And that's where you are seeing the community actually bettering. And when you see that investment, then okay, all these things line up. This is, very simple. You can do all that stuff in 5 minutes online for picking a market or looking at a market, and you can pull it. And that's where you really know exactly what's going on there.
Right. Again, it's the numbers, isn't it?
Yeah.
So just to wrap it up, Charles, it's been very insightful for me, from Australia, from outside looking in. I think it's really fascinating. And so as an entrepreneur, because it looks like you really haven't had a proper day job since you left college, as an entrepreneur, what are some of the top 2 or 3 things you've learned along the way that you could share with other want-to-be entrepreneurs, those who want to start a side hustle? You obviously did a side hustle in real estate, which is very cool. And a lot of people do. They put their toe in, buy one, then keep going. So what are some top tips, 2 or 3 tips? One tip for people that want to be an entrepreneur or just starting the journey. What have you learned along the way?
I would start that side hustle with as little money and time as possible, and get a proof of concept. You know what I mean? So make some money. You don't have to do anything. You don't need any fancy, just whatever what they say in Silicon Valley is the minimal viable product. Put out the smallest thing, make something on it. And then you're like, oh, wow, holy, this thing works. Let me go to the next step. And then you can build on that. And if it doesn't, what did you wasted a weekend of building some stuff and putting it out there. So that's what I would say. Number one. And the other thing too, is that, it's a difficult thing with people that are entrepreneurs, especially with all the stuff that we're all over social and online, all these shiny penny type things. So it's difficult. You got your day job or something you're working on, and then you got a side hustle, but trying to keep focus on both of them and really breaking time, because when you start spreading that over a number of different things, that's when you're not exceeding anywhere.
Yep. And that's what you essentially did. You started that payments business, and you've I think you don't focus on that now. I think your brother does. Is that correct?
Yeah, my brother handles that. And then we have 2 full-time people, well, 1 full-time person and another part-time person that work on that property, that business as well with my brother. Right. But I check in on that sometimes. It depends on if there's a large client that comes in, that's something that I'll take those calls. But it's not something that on a daily basis, no.
Cool. Charles, thank you very much for your insights. It's been really cool. I've learned a lot, and that's almost the only reason I do this, because I just learn from the smartest people in the school, frankly. And you're one of those. You've obviously learned a lot along the way, and thank you very much for sharing your wisdom and experience. And I think there's a lot of wise investment tips in there. Any one last thing you'd like to share with the listeners before we leave, or?
Yeah, if anybody's ever interested in learning more about investing in the United States or investing passively or actively, you can go to our website, harborsidepartners.com. And if you go to harborsidepartners.com, and that's spelled Harbor side both ways, just, the English way and the US way, with or without the U. So don't worry about that. And if you go to the website, we have a lot of information on there. I have a podcast, we have a YouTube channel. So learn more about what we're doing if you're interested in, expanding horizons out of your home country.
Great. And that's, for me, was I really enjoyed expanding my horizons, because I do know the markets between Australia and the USA are quite different. So it's, but on the same, what is the same is you just got to do your numbers. And, and I think what you guys do is you minimize risk by bringing your expertise and experience as the manager or of the syndicate, if you like, my best way to describe it. And you've got a track record. So that's fantastic. So thank you, Charles, for sharing today. It's been absolutely awesome. Thank you.
Thanks for having me on, Jeff.